Shanghai, $104 silver close, $10 plus premium over West, $90. GSR crashes below 50 DMA. OG John XXX here. Silver Western spot, 90. Futures, 90. Shanghai spot, 100. Futures, 104. $10 premium, and it is not closing. Gold, 51.85. GSR, 57 and falling. First notice day 2 days out. Registered silver, 87.2 million ounces. Open interest, 115 million. You already see the problem. This is not a normal market. Let me show you exactly what is happening right now and why the next 48 hours matter more than anything we have seen in months. For the chart watchers, strictly educational, not a signal. We had resistance sitting at 87.20 to 89. Price broke through that zone with an hourly close above. Ran directly to 91.14. Pulled back to 90, structure held. Lower time frames remain intact. Next objective is 92. That former resistance is now acting as support. This is what real structure reading looks like. You identify levels before the move, not after. Price came to the level, reacted, and moved. That is the sequence. If you are learning and following along, drop a comment below. Just write OG John XX so I know you are watching and paying attention. That's all. Just let me know you are here. Now here's the data point that changes everything. Registered silver at CMX keeps falling. 87.2 million ounces available right now. Yesterday alone, 71 million ounces were rolled. That is the largest single-day roll we have recorded. And here's what that roll told us that most people missed. Price did not drop during the roll. Price moved higher. When 71 million ounces roll and price rises, that is not weakness. That is demand absorbing pressure and still pushing higher. That matters. Write that down. Total open interest entering settlement in 48 hours sits at 115 million ounces against 87 million available. That gap is not theoretical. That gap is structural. And while force majeure was the conversation dominating last month, today's data has shifted that picture. The roll happened. The catastrophic delivery failure did not materialize. But here is the critical detail that most people are glossing over. Force majeure not happening does not mean pressure is gone. It means pressure was deferred. Those are two entirely different things. Physical silver ownership inside CMX vaults is not evenly distributed. That is the detail worth sitting with. You cannot look at aggregate registered stocks and assume every short is safe, simply because the headline number looks manageable. Uneven distribution means pockets of real delivery stress can exist, even when the surface number appears comfortable. Some shorts remain exposed regardless of the roll. That is not opinion. That is mechanics. On Tuesday, another 1 million ounces were removed from registered availability. No new metal is coming in to replace it. The absence of new supply entering CMX is not a footnote. It is the story. When supply keeps leaving and nothing replaces it, you do not need a dramatic event to move price. You just need time. The reason I keep returning to this table every single day is simple. I am tracking whether silver trades materially higher later in 2026. The driver will be demand proving larger than available supply. You track that by watching one number: how much silver is backing the futures market. That number is falling, and it is expected to keep falling. Here is how the sequence typically unfolds. First, you watch the March-May spread, or later the May-July spread, flip from contango into backwardation. When that happens, expect outflows from CMX to accelerate hard. Then retail investors begin to realize the move was not a one-off spike. They start buying ETFs. ETF buying removes even more physical from the market. Each step in that sequence tightens the next one. That is not speculation. That is the mechanical pathway. Now, let us talk about Shanghai. Shanghai silver closed at 104. Western spot closed at 90. That is a $10 premium for physical silver in Asia over paper pricing in the West. That gap has not closed. It has widened. When a premium of that size persists and grows, it is not arbitrage noise. It is structural dislocation. Someone in Shanghai is paying $10 more per ounce to own physical silver right now. Ask yourself why. SHFE suspended 25 trading groups in February alone. Official reason? Accounts exceeded daily opening limits and violated exchange trading rules. Translation? Someone was pushing size aggressively, and the exchange stepped in to manage the risk. You do not suspend 25 groups in a single month unless something abnormal is building. Exchanges act when risk concentrations rise to levels that threaten orderly markets. Verify this yourself. SHFE publishes suspension notices publicly. Go check. The data is there. Why does this matter beyond China? Because SHFE is one of the primary physical linkage markets for silver globally. Stress there does not stay there. It affects global flows. When an exchange begins enforcing limits aggressively, it signals volatility risk, position concentration, liquidity imbalance, and potential delivery stress compressing into the same window. All of that is happening right now simultaneously. GSR has broken back below the 50-day moving average. Current reading, 57. When the gold-silver ratio compresses from above 60 down toward 50 and then breaks below moving average support, it signals a sustained shift in relative demand. Silver is no longer behaving like the chronic underperformer it was for years. Silver touched 91.14 this week. That print sits above the 50-day moving average at 81. Since May 30th, that 50-day moving average has not declined. A rising moving average with price holding above it is not a bounce. That is a bull market structure. There is a difference, and it matters. Now let us talk about Mexico. Mexico is the largest silver producer on Earth, and for the first time in recorded history, silver was declared a critical mineral. It is embedded in AI infrastructure and defense applications. 50% of U.S. silver imports come from Mexico. The U.S. has modeled supply disruption scenarios from Mexico and connected them directly to GDP impact and national security risk. That is not fringe analysis. That is government modeling. Here's what is happening on the ground right now. A few days ago, 10 workers from a major mining company were abducted. 3 were found dead. Mining companies are struggling to attract workers in affected regions. Security costs are rising sharply. Cartel-related disruptions to silver transport are increasing. Even before this incident, the trajectory was worsening. You cannot separate supply risk from what is happening in northern Mexico right now. All of this is unfolding inside a market that has run a supply deficit for 5 consecutive years. CMX inventories have been draining steadily throughout that entire period. The world needs silver, and the largest supplier is under pressure. Those two facts sitting together in the same sentence should get your attention. The Trump administration's coordination with the Mexican government may be moving toward restoring federal authority in cartel-dominated regions. Genuine enforcement there builds economic stability across the hemisphere. Mexico's raw materials, and silver specifically, make stable conditions a direct U.S. strategic interest. Early signals suggest the situation may be stabilizing. When cartels begin targeting assets connected to upper-class economic infrastructure, including the mining sector, the response historically becomes decisive. That dynamic appears to be developing. Now, let us look at the other side honestly. 71 million ounces rolled yesterday. Roll mechanics worked. Force majeure did not materialize for March. The Shanghai premium could narrow if Chinese demand moderates or Western supply increases. The Mexico situation could stabilize faster than expected with coordinated government action. Those are real possibilities, and they belong in the analysis. Daniel Kahneman wrote in Thinking Fast and Slow about how human psychology defaults to System 1 thinking during periods of market stress. Fast, intuitive, emotional. Rather than System 2, which is slower, deliberate, and logical. The psychological pressure on shorts right now, with 48 hours to settlement, a $10 Shanghai premium, 25 SHFE account suspensions, and escalating Mexico supply risk, is generating System 1 panic responses. When that panic expresses as forced covering rather than rational position management, it produces discontinuous price moves. That is what volatility is currently pricing. Gustave Le Bon documented in The Crowd how collective psychology in markets shifts suddenly when the crowd realizes it is positioned wrong. Individual rationality gives way to herd behavior. 25 account suspensions at SHFE in a single month tells you crowd positioning was extreme enough to force exchange intervention. When the exchange confirms the setup by stepping in, the setup was real, not imagined. Bottom line, 48 hours to settlement. Registered 87 million. Open interest, 115 million. Shanghai premium, $10 and widening. SHFE suspending accounts for aggressive positioning. Mexico supply risk, escalating. GSR breaking below moving average support. Technical structure intact above 50 DMA. Force majeure deferred. Not resolved. Pressure remains. Watch how this market behaves over the next 48 hours. Verify CME data yourself. Check SHFE enforcement notices. Monitor the Shanghai premium daily. The people who do that homework understand what is building here, without needing anyone to explain it to them after the fact. Invest with logic, not hype. OG John XX, out and about.